We ended part 2 of this section with the idea that we can reduce risk with diversification. We can put multiple assets into a portfolio and that will lead to a lower standard deviation. In this video, we'll come up with a new measure of risk that will capture the portion of risk that investors should be compensated for. First, some background on risk and the concept of risk aversion. We could summarize risk aversion by asking this question: would you like to play this coin flip game? If the coin lands on heads, you win $100. If it lands on tails, you lose $100. Now notice that this is a fair game with an expected value of $0. You're as equally likely to win the $100 as you are to lose it. But most people would choose not to play. Why? Because most people tend to be risk averse. The existence of car and health insurance is evidence of this. People are willing to pay to avoid taking on risk. Given the option to take a risk by gambling, which is a 50-50 chance of winning or losing $100, versus the sure thing, not playing and receiving $0, people would largely avoid taking this risk. How do you think we can get someone to play this game though? Is there anything we can do to encourage them? Well, we can give them some extra compensation. Maybe say if the coin lands on heads, you get $120, and if it lands on tails, you lose the $100. If we did that, more people would be willing to play. This extra compensation is like a risk premium. If you want someone to take on more risk, you need to compensate them for it. Investor behavior is consistent with this idea of risk aversion. If you want to encourage someone to expose themselves to more risk, you must be willing to compensate them with more return. So we have this risk and return trade-off. But what we're going to see here is not all risk is relevant. Given the fact that investors are able to use portfolios to reduce their risk, makes one type of risk important and the other irrelevant. Because one type of risk is irrelevant, we'll show that investors should not be compensated for exposing themselves to it. So the more risk you take, the more return you should get, but only for a certain type of risk. This is going to lead us to a model called CAPM, the Capital Asset Pricing Model, which is going to quantify the risk and return trade-off. It's going to tell us what type of return you should expect given the amount of risk you're exposed to. The CAPM can be derived using complicated math, but instead I'm going to try to motivate it using some basic logic and a very simple story. We can start off with the basic and fundamental question: why do stock prices change? Remember that the value of a stock is just the present value of its future cash flows. Well, the only reason a stock would change in value is if people's expectations about its future cash flows change. If nothing ever changed about expectations, then the price would never change. News is new information, and that new information can change what people think about a company and thus lead to price changes. News can be broken up into two parts. There's an expected component to news, and there's an unexpected or surprise component. An example of this is when a company publicly announces its earnings for the quarter. Prior to the release of this information, people have expectations about this number. There's a whole industry of financial analysts whose job it is to try to forecast companies' earnings. When the company publicly announces their results, this will be their actual earnings, and this is likely to differ from what's expected. The difference between what actually happens and what's expected can be considered the surprise component. And it's this surprise that causes stock prices to move and generates a return. And it's usually really obvious when a surprise occurs. It's often reflected by the price movement we see in the stock market. Take, for example, Apple's earnings announcement on July 30th, 2020. Their actual results differed dramatically from what people expected, both in terms of earnings and revenues. They sold $4 billion more iPhones than analysts expected, and their actual earnings per share was more than 50 cents higher than expected. So how do you think the stock market reacted? Immediately when the announcement was made, the price of Apple stock jumped upwards because this was good, unexpected news. What do you think would happen if Apple's results were right in line with expectations? Probably nothing. The price wouldn't move much because people's estimates of the future cash flows wouldn't be affected. So now we know what causes prices to change, and we can translate that into returns. And so we can say the total return a stock produces can be broken up into an expected return component and an unexpected component. And the unexpected component is going to correspond to the surprises we just talked about. We can go further and break down that surprise, the unexpected return component, and say it's comprised of a systematic portion and an unsystematic portion. The systematic portion is going to represent surprise news that affects all companies in the economic system, no matter the industry, the location. There's no hiding from the effects of these things. So it could be things like macroeconomic policy from the Fed, a pandemic, a major recession. No matter what your business is, you're going to be affected by these types of news in some type of way. Contrast that with the unsystematic portion. This is going to represent surprise news that's only going to affect a limited number of companies, maybe a certain industry or geographic region, or maybe just one company in particular. Some examples would be like a labor strike at Walmart, or a parts shortage at General Motors. A parts shortage at GM would definitely affect GM, but it would likely have no impact on a company like Apple. Therefore, that would be unsystematic. So we could take our total return equation and write it as the expected return plus the systematic unexpected return plus the unsystematic unexpected return. We can do the same breakdown for risk. We can decompose total risk, which is measured by the standard deviation, into two parts: systematic risk and unsystematic risk. Systematic risk is risk that affects all companies in the economic system. For reasons that's going to be clear soon, this type of risk can be called non-diversifiable risk. Unsystematic risks are risks that's going to only affect one company or a certain group of companies. And this is going to be called diversifiable risk. As we showed when we were talking about portfolios, through diversification we can reduce total risk, that's standard deviation. But what we'll show here is that we can't get rid of all the risk. That is, we can't push standard deviation all the way down to zero with diversification. In this chart here, we can see what happens to the standard deviation of a portfolio as more and more stocks are added to it. With just one stock, the standard deviation is pretty high, nearly 50%. But as more stocks are added, the standard deviation declines, as expected. If you have a portfolio of Apple, General Motors, and Facebook, when some bad news comes out about one, there's likely to be good news coming out about another. So the good cancels out the bad, and that leads to less volatile returns. That's the benefit of diversification. But you'll notice there's a limit. It's probably better illustrated with this graph of the data in the chart. As we get to around 100 stocks and above in the portfolio, the blue area, the unsystematic risk, pretty much disappears, and the standard deviation remains about the same level, around 19.2%. At that point, it doesn't matter how many more stocks we throw in, the standard deviation will stay pretty much at that level. The risk that remains and cannot be diversified away will be the systematic risk. That's the green region. Now think back to what systematic risk is. It's a type of risk that's going to affect all assets in the economy. There's no hiding from this risk. So no matter how many stocks you put into your portfolio, you can't diversify it away. Think about the extreme case where you hold every single stock in the market. If a global pandemic hits, then all those stocks will be affected by that news. That's why we call this risk non-diversifiable. So the total risk of a portfolio, the standard deviation, contains both the systematic and unsystematic risk, or non-diversifiable and diversifiable risk. But through diversification, we can pretty much eliminate the unsystematic component, leaving just the systematic risk. We talked at the beginning about the risk and return trade-off. The more risk you take, the more return you should expect. Well, it turns out that the market won't compensate you for taking on unnecessary risk. Unnecessary in the sense that you could easily eliminate the unsystematic risk through diversification. So there's a risk and return relationship, but the relevant risk is the systematic risk. The more systematic risk you take, the higher your expected return. That brings us to the CAPM, the capital asset pricing model. This model will give us the relevant risk and return relationship. That is, it illustrates the relationship between systematic risk and return. Again, the more systematic risk you take on, the more your return you should expect. Now we just need a way to measure systematic risk. We have a way to measure total risk, that's standard deviation, but we need to capture just the systematic part since that's the only risk that's relevant to investors. We can measure systematic risk with beta. Beta is the coefficient from a linear regression of assets return on the return on the market portfolio. In the market portfolio, it represents a collection of all assets in the entire economy. All the stocks, all the bonds, all the investments. It's impossible to measure the return on everything, so the market portfolio is often represented by something we can measure, like the S&P 500. The S&P 500 is a portfolio of 500 large company stocks and can be indicative of the performance of the entire market overall. We can interpret this beta coefficient as a sensitivity. How sensitive is a stock's return to the performance of the overall market? If the overall market goes up by Z%, how much does stock X tend to go up? If a stock has a beta equal to 1, then it has the same systematic risk as the overall market. And we can interpret it like this. If the market goes up in value by 10%, we can expect this stock to increase by 10% as well. If the asset has a beta that is greater than 1, then it has more systematic risk in the overall market. So if the market goes up by 10%, this stock would go up by more than 10%. It's highly sensitive to the stock market's movements. And finally, if an asset has a beta that's less than 1, it has less systematic risk in the market. If the market goes up by 10%, then the stock would go up by less than 10%. In this case, the stock wouldn't be very sensitive to the market's movements. Let's play with some specific numbers for beta to more clearly see what it means. So we have an asset with a beta of 2. What does that mean? Well, it means it's highly sensitive to the market's movements. It tends to do double what the overall market did. So if the market went up in value by 10%, this stock would go up by 20%. And on the downside too, if the market goes down by 10%, this stock will decrease in value by 20%. If a stock has a lower beta, 0.5 for example, we would see less sensitivity to the market. If the overall market goes up by 10%, we'd expect this stock to increase in value by just 5%. And we see the lower sensitivity on the downside too. If the market goes down by 10%, we'd expect this stock to decrease by 5% as well. Here are the betas for a few sample companies. We can look at Walmart and Kellogg as examples of low beta stocks. These two companies aren't sensitive to the conditions of the market. Whether things are good or bad, people will still shop at Walmart or buy Kellogg food products roughly to the same degree. So they're not very exposed to systematic risk. Carnival Cruise Lines, on the other hand, are highly exposed to systematic risk and thus has a high beta. When there's good news about the economy coming out, people are more likely to spend their money on cruises. But when things are bad, the industry pretty much shuts down. So they're highly sensitive to the conditions of the market and thus have a high beta. Two key betas you should keep in mind are the beta of the market and the beta of the risk-free asset. The beta of the market portfolio is equal to 1. This is because how we define beta. Beta is the sensitivity of an asset to the market portfolio. How much does the asset move in response to movement in the market portfolio? Well, how much does the market portfolio move in response to the market portfolio? It's going to be a 1-for-1 movement. So the beta of the market portfolio is equal to 1. For a risk-free asset, its return is completely stable. It doesn't change, so there's no sensitivity. When the market goes up, the risk-free asset stays the same. When the market goes down, the risk-free asset stays the same. You can also notice that the risk-free asset has a total risk, a standard deviation, of 0. So if it has 0 total risk, it must also have 0 systematic risk. All right, now let's start putting all these ideas together into an equation. We'll start with the idea of equilibrium. Equilibrium is a state in which everything is stable. Everyone's happy where they are, and nobody wants to change their position. Equilibrium in finance is when nobody has an incentive to trade their assets. In equilibrium, we can say that all assets have to have the same reward to risk ratio, with risk being systematic risk measured by beta. This here is a reward to risk ratio. The return on stock I minus the risk-free rate is the reward, and the beta of stock I is the risk. If you could identify a stock that had a higher reward to risk ratio, you would dump what you currently have and you would purchase that. But then we wouldn't be in equilibrium. In equilibrium, all assets must be equal in this regard. And this includes the market portfolio. It also has to have the same reward to risk ratio as everything else in equilibrium. We can take this equation and cross multiply and substitute the fact that the beta of the market portfolio is equal to 1. And we end up with this equation in blue. This is the CAPM, the capital asset pricing model. The CAPM says that the expected return on some asset, asset I, is equal to the risk-free rate plus the asset's beta times the expected return on the market portfolio minus the risk-free rate. We can look at all the stuff after the risk-free rate in this equation, and that's going to be the risk premium of the asset. That's the compensation an investor gets for taking on this risk, the risk of this investment. That's the stuff in the brackets. The stuff in the bracket, the expected return on the market minus the risk-free rate, is often called the market risk premium. And this is the compensation you get for taking on the risk of the market. Now let's use a CAPM to estimate some expected returns. Suppose the risk-free rate is 3% and the expected return on the market is 9%. What should the expected return on Walmart be? Remember that Walmart is a low beta stock. Its beta was 0.28. Putting that beta into the CAPM equation, we get an expected return of 4.68%. Let's also find the expected return for Carnival Cruises, which had a high beta of 1.97. Putting their beta into the CAPM gives us an expected return of 14.82%. So as you can see, as systematic risk increases, the expected return increases as well. I want to spend a quick minute on the economic intuition behind the CAPM. Imagine that you put all your wealth into a high beta stock like Carnival Cruise Lines. If the economy is doing well, people will be taking cruises and your stock will be performing well. But if the economy is bad, then people will stop taking cruises and your investment performs poorly. In that first scenario, Carnival Cruises is doing well when you least need the money. The economy is doing good, your job is probably stable, your other investments are doing fine. But in the second scenario, Carnival Cruises is doing bad when you need money the most. In this scenario, you might be losing income from your employment and all your other investments are doing poorly too. So holding Carnival Cruise stock is very risky in the sense that it can make a very bad situation even worse. Because people tend to be risk averse, they're going to demand extra compensation to purchase a stock like Carnival Cruise Lines. The final thing we need to touch on is computing betas for a portfolio. Because people tend to form portfolios, we need a way to quantify the systematic risk of a portfolio, their beta. And the beta of a portfolio is simply the weighted average of the individual betas of the assets in the portfolio. We can do an example to illustrate. Let's say you have $1 million spread out among 3 stocks. $300,000 in IBM, $200,000 in Carnival Cruises, and $500,000 in Walmart. And the betas for these stocks are 1.16, 1.97, and 0.28, respectively. And what's the beta of this portfolio? First, we need to find the weights of each of the stocks in our portfolio. What percentage of the total investment goes into each stock? Well, 300,000 out of the total million is going into IBM, so 30% is in IBM. 20% is going into Carnival, and 50% is going into Walmart. Next, we just multiply the weights by the betas and sum them together. 30% of the portfolio will get the 1.16 beta, 20% of the portfolio will have a beta of 1.97, and 50% of the portfolio will have a beta of 0.28, giving us a total portfolio beta of 0.88. This will be the systematic risk of the portfolio. If you play around with this, you'll notice that as we add more and more of the riskier Carnival Cruise stock into our portfolio, the portfolio beta will increase as well. And what do you think that's going to do to our expected return? Of course, it's going to increase too.